Okay, great. See, now let us forget about the stock markets. This is going to be very interesting. Let us forget about the stock markets. Let us make a new stock exchange actually. Okay. Unfortunately, the battery on my this phone has given me a warning signal. I'll just call you back from my landline. Just give me one moment. Okay. Okay. Give me that now. phone. इसका बैटरी खोल के इसमें लगाओ. Hello. Yeah, I'm sorry for the interruption. Okay. So, in the stock market, we have this Reliance infrastructure, and the first thing which I did with you is that I showed you the stock chart for the last 12 years. Okay. So, the minimum price which you saw in these last 12 years was something around maybe 200 rupees in the year 2000, 2003. Okay. And from there it went up as high as 2600 rupees. What I mean to tell you is that there is no guarantee of price in the stock market. So something trading at 500 rupees today can move down to zero, or it can also move up to 50,000 rupees. Now, in our language, the price of any financial instrument can go from anywhere between 0 to infinity. Please note this down. The price of any stock in the Indian stock markets can go anywhere from 0 to infinity. Okay. Am I right, sir? Now, what happens? I'll tell you. Give me the answer of a simple solution, simple question. Do you generally buy and sell in the market, or do you generally short sell and then cover in the stock market? Okay, so you are saying that you generally buy and then sell. You seldom do short and cover. I'll tell you the reason for this. There are many things, I don't know, like why did God create me? Does God exist or not? There are a number of questions in life to which we do not have a solution. Have you ever tried to ask yourself, why do you generally first buy and then sell? Have you ever thought, why do you generally first buy and then sell instead of shorting and covering it? There can be two things. What with your statement, you said that anything can go up. Either you are a very optimistic person, or there's no other option, right? I'll tell you what happens with the human heart. Okay, whenever you buy something at 50 rupees, the obvious thing that happens is that you think that the maximum money which you can lose in the stock market is 50 rupees, right? And the maximum you can gain is infinity. So, when I sit down to calculate my risk divided by reward, risk is to reward ratio, it gives me a strange figure. It is 50 divided by infinity, right? So, any number divided by infinity is equal to 0. So, when the stock is trading at 50 rupees, you know that if I were to lose money, I lose 50 rupees. If I make money, I make unlimited. And tomorrow, if this 50 rupees stock trades at 60 rupees also, you cannot calculate the risk is to reward ratio, because it stays the same with the national stock exchange at 0 for every stock, though everyone says that stock market investment is subject to risk. However, when you are shorting something at 50 rupees, your risk is unlimited and reward is 50 rupees. So your risk is to reward ratio becomes infinity. That is why the average human retail trader never short sells into the stock market. He generally buys and then sells, and that too, again, he's wrong. Now, second point I would like to tell you, I'll rather first ask you, how long have you been trading in the stock markets? Okay, great. Do you think you have made money in these 2 years, or do you think you have been a loser out in these 2 years? How much, to be precise? So you say that in 2 years' time you lost 2 lakh rupees. Okay, very unfortunate, but this is something which has become a sort of general question for me to ask people, and I get every figure from, yeah, I have got every figure from a few couple of thousand rupees to crores of rupees till date. But I'll rather tell you that, sir, you are an engineer. Yeah, yeah, everybody loses money in the stock market, but overall he is a winner. Okay. So, the reason why I need an educated client rather than, I could have easily told you that, you go ahead with my consulting service, or, you take my broking service. Honestly speaking, we have a very strict philosophy which we are following these days, that, I'll rather have an educated client rather than not having a client. I'll have an educated client, but not an uneducated client. I'll give you a number of reasons for this. Tell me, how many trades might have had done in the last 2 years? I guess you might, yeah, you might not be able to remember, but on an average, a person in 2 years does a trade of at least 100 crore rupees. With it must be more than that, sir. For a person with an average, you don't have an idea actually. But anyways, I'll rather ask you a simpler question. Tell me, if you are doing 10 trades, how many trades do actually turn profitable? You got my question? So you mean 1 in 3. So that is 4 out of 10. Was it intraday? Give me a figure for positional. Give me a figure for positional trades. What do you think? On an average, I'll tell you, sir. Yeah. Hmm. Okay, great. So it's zero. It's 0 on 10. Okay. It's very unfortunate. Okay, I'll tell you about my average client. Okay, my average client says that 6.5 to 7 trades out of 10 they do right. Okay, and they do make 2 rupees on that, 2%, 3% on every correct trade. But in the losing trades, they lose a lot of money, because you told me positionally you always lost money because you converted an intraday position into the positional basis. That is the only reason for your 100% loss in positional trades, I guess. So my average client tells me that they make 2-3% on 60-70% of the trades, but on the remaining 30% of the trades they lose 10-15-20%. And that is what is the big issue with the stock market. I'll tell you, there are two things in life which we can personally do. The first option is we can earn money, and the second option is we can beg for money, we can borrow money, or we can even steal money. Beg, borrow, steal. Now, what actually happens in the stock market, if you don't actually mind my tongue, I would like to tell you why human sentiment does not allow you to take profits off the table, and why in the case of a loss you keep on holding it on a positional basis. From the psychological analysis of so many of my clients, I've seen that whenever they are losing money, they feel that it's their hard-earned money from their existing business or job or okay, something happened. Okay, from their business or maybe their jobs or something, and they don't want to lose their hard-earned money because they love their hard-earned money, and therefore they don't exit when they are onto a loss-making proposition. There are again some clients who say that they had borrowed a lot of money for investing, and taken a lot of exposure, and they didn't know what to do, and therefore they lose money. Now I'll tell you what the reason behind why a person cannot take a huge profit. Why, most of the traders, 70-80% of the traders book profits in only 1 or 2%. The reason is that whenever I get a profit of 2% or 3%, the general human tendency is to feel that I didn't actually deserve this money. It's just a matter of chance. Let me take off this money off the table because tomorrow anyway the stock is going down, right? So, hello, are you there, sir? Are you there, sir? So, so do you agree to this fact? Uh, so see, I'm not very sure about you because I know this is only the past 30-40 minutes, but with most of my clients this is the big issue. So that is why in this first technical demonstration class I would rather prefer doing a lot of directional analysis, doing a lot of risk analysis, and doing a lot of exit policy, so that even with the basic information you can go ahead. Now with the stock market, the normal stock market. Okay. Okay. Okay, great. So this single statement of yours says that you have been trying to do a lot of research without much success, I guess. Anyways, after tonight you will not say this. I'll ensure that after tonight you do not say this. That you do not have the technical expertise. So let us come back. The price of any stock in the stock market can go anywhere between 0 to infinity, and that is why, going by the rules of probability, a person generally buys into the market rather than short selling the market. However, let us consider a different case. My name is Ashwin, and let us make a new stock exchange known as Ashwin Stock Exchange. Okay. Now, in the normal stock exchange, we allow a stock price to be traded anywhere between 0 to infinity. Okay. But I would rather make a stock exchange where the maximum price of any particular financial product will not be more than 100 and the minimum will be only 0. So obviously I can't be going into negative numbers. The maximum will be 100, the maximum permissible tradable price will be rupees 100, and the minimum will be rupees 0. You got my point? Please tell me, would you prefer trading in the National Stock Exchange or the Ashwini Stock Exchange? Okay, so you say that you would go in for the Ashwin Stock Exchange, and trust me, out of the last 10 demonstrations I've given you, you are the first person who has chosen my name. And just to make this question easy, I use my personal name attached with this stock exchange, so that at least for the sake of that, people say that okay, Mr. Ashwin, I would rather trade in your exchange. But there's a big reason. People actually choose the National Stock Exchange because they again come back to the same thing, risk is to reward thing. That array in my NSC I can buy for 50 and sell for 500, but they have never done this in the past. They hope that they would be able to do it someday, and they never take my name. So thank you for taking my name. So we have this strict rule: the Ashwini Stock Exchange will not have any stock trading beyond 100 rupees, and they will not be having any stock trading below 0. Now this basically means that I am allowing a stock to oscillate between an upper band and a lower band. Am I right, sir? Okay, great. So basically there will be a lot of oscillations, and the other day around I was trying to explain simple harmonic motions to some of my audience, and it gets really on my nerves to explain amplitude and um, vibrations. And the other day I was taking out we have this charger, this this mobile chargers. I took that as a piece of thread, and showing vibration to people, so it really becomes very difficult for non-technical people for me to explain. So anyways, it will be very easy for me to go ahead with these things. So um, uh, just click on OK now. We can proceed now. Just click on OK. Okay, great. uh, Now, for the sake of simplicity, let me do something like this. Okay. Yeah, yeah, this is fantastic. Now, what I try to do is that I reduce the time frame to maybe the last 1.5 years, because that is enough. Otherwise I would not have a distinctly clear signal. Honestly speaking, this is not one of the best stocks to trade. This is honestly not one of the best stocks to trade, but still, when I have given you a commitment, I have to fulfill that. That I have to explain everything on the basis of the charts of Reliance Infrastructure. Okay. See, portfolio is something for which we have to come down to fundamentals. So maybe at the end of this demonstration, I'll tell you the fundamental facts of this company, which I know. Okay. Fundamental is another thing, but right now it's technical. So give me 30 minutes. We'll come back to that question also. Okay. So Reliance Infra is actually not one of the best stocks to actually trade, but still, for the sake of it, we'll go ahead with this. Rather, I would be much more happy if you could choose a much more better tradable stock like the DLF and the JP Associates, and where we have volatility, where we have liquidity and all. So otherwise, you are not going to get a lot of money actually. Okay, let's go ahead with you said DLF, HDL. Okay, great. We can continue with any stock. That is not an issue for me. Okay, great. Now, except for this huge correction, this is also technically correct. There was a technically selling short sell call on 21st January 2013. But let's see step by step. Point number one. Please now note everything very carefully. I have kept my mouse anywhere on the computer screen. At the top you can see the date, the price 13 December 2012, price 115 rupees 60 paisa. Corresponding volume it's 1.08 crores, and we have something known as the stochastics value, which is written as 36.44 comma 54.70. Okay. Now for the sake of simplicity, I will read 36.44 as 36 and 54.70 as 55, some simple approximation. Okay. So 36 and 55 are two numbers which is in front of my screen right now. Let us represent 36 comma 55 as x comma y. Rather than x comma y, I would tell you that consider it as g comma r, because that is going to help us remember the importance of this number easily. Okay. So did you get my point? We will call 36 equal to g for green maybe, and 55 equal to r for red. Okay. So instead of terming it as x comma y, I'll term it as g comma r. Is that okay, sir? Okay, great. Now please write down rule number 1, which you should not break. The first principle which I came was directional analysis. The directional analysis says that irrespective of whether I am making money, losing money, irrespective of anybody is advising me, strongly advising me, irrespective of whether there is a bomb blast, irrespective of anything in this world, on this earth, from tomorrow onwards, you will not buy a stock if G is less than R. You will buy a stock only and only if the value of G is greater than R. The simple reason being, if the value of G, unscientific reason being that G stands for the bulls and R stands for the bears. Just assume it this way, so it will be easier to understand. If the value of the bulls, if the strength of the value of the bulls is greater than the value of the strength of the bears, then only you can go long and make money. Is that clear, sir? Okay. If G is less than R, it will be a sell. Please do not ever break this rule. Okay, never in your life go against it. Whenever you go against it, you will always lose money. That is something. Yeah, sure, you can ask your question. Yeah. Okay, you want to know more into technical. Great. As I told you, at the time of attaching the stochastics, I showed you a certain number of things like percentage K, percentage D. So the left hand side data stands for the short period data, and the right hand side stands for the long period data. In this we have kept short period data equal to 3 days and long period equal to 5 days actually. If you search more about stochastics immediately on Wikipedia, you will see the whole calculation in which the last 5 days differential closing prices are taken into consideration. So that is a lot of engineering and mathematics which the system does for you. Okay. D. Yeah, so it's actually in terms of percentages, but to make things easy, let us not try to understand so much. We'll just consider it as simple numbers between 0 to 100. Okay, because otherwise, it will get a bit confusing. We'll come to the details in the second class preferably. Okay, so I hope you don't mind. Okay, but they are percentages, they are not absolute numbers, they are indeed percentages only, but let us go ahead at this point of time as absolute numbers. Yeah. So now let us forget the percent k and percent d, because you will get confused after some time. Just consider two alphabets, G and R, nothing else. And G stands for green, green stands for bulls, R stands for red, red stands for bears. This is the easiest way to remember it, because I'm sure after 7 days you would be getting confused with this whole chart actually. Okay, so that is why I have chosen a philosophy which might sound very unengineering types. Okay, but this is something which helps me explain this simple thing to people across India actually. Okay, so that is why I use this simple example. So never again in your life you'll buy anything if the value of G is less than R, and you'll only buy if the value of G is greater than R. Okay, so I have covered the first point, the most important point, which was directional analysis. There's nothing else which you need to know. If you are in Hyderabad railway station and if you can see which side the engine of the train is, then you definitely will be sure whether the train is going to Vizag or Bengaluru, as you told me, right? The second thing is risk analysis. Okay. Now, for the sake of simplicity, first we will. Hello, sir. Are you online? Hello. Yeah. Okay. For the sake of simplicity, we will be considering only buy side trades, because you also told me that you'd never like to short sell a stock and then cover it. Okay, but it's generally not always. Okay. So first of all, we would be I would be telling you only about how to buy and sell. Okay, and when we are sure with profiting on buy and sell trades, then we would go to short sellings. Okay, now since I'll be having a simple formula, the reverse of that will be true for short selling actually. Okay, so the next step is, for risk analysis, please find out the average of G and R. So in this case, we had something like 36,55. 45. Okay, no, it was 36,55 actually. In the first example which we have taken, it is 36,55. So the directional indicator tells me go short. So at 116 rupees on 13 December, I would not have given you a buy call on this. Okay. Rather, we will try to find out a position in which my first condition gets satisfied. So we'll give new values to G comma R. Okay, I see that this one is an excellent example. 21st November 2012. The data is 32 comma 26. Okay. Okay. No. Please see again. It is 32 and 26. Okay, great. So it is 33 and 27, right? Okay, great. So just consider the average. So the directional indicator tells you what? Plus or minus? Yeah, G is greater than R. So okay, so great. It will be a buy call. Okay. Now, as soon as you decide to buy a stock, please wait. You need to consider what is risk is to reward. Now, in this National Stock Exchange, the risk is to reward is always zero when you are buying a stock. Mathematically, it is zero, but actually, it is unlimited. Okay. In the Ashwini Stock Exchange, we have a very simple way of calculating things, because we have a lower limit of 0 and a maximum limit of 100. Right, sir? Great. Now, what I'll do is that I'll do the average of G and R. So, in the first case, my data is 33 comma 26, right? No, it will be 30. Okay. Now, I am assuming that please don't mind, I am assuming that your capital is going to be 1 lakh rupees. Okay, please remember this calculation, which is known as the risk management. Until and unless the risk management is not proper, You will never make money in the stock market. I hope you know this. 90% of people, trade on the same quantity every day, irrespective of market conditions. I have personally seen this thing. So 90% of people, if you do not do risk management, you will be a loser in the market, because there will be trades on which you will lose money. But my philosophy of trading is make big profits, make small profits, and make small losses. If I go with make big losses philosophy, then what happens is that uh, I will be actually wasting your money. So you'll be actually losing your money if you go with big losses philosophy also. Okay. So please let us assume that your maximum capital is 1 lakh rupees, which you are never going to invest in the market. So let us assume a case where the average of G comma R is equal to 10 only. When it is going to be at 10, I'll be investing 90,000 rupees in that particular stock if it is a buy call. The average of G comma R. Are you getting me, sir? If it is, yeah, if it is 10, I'll invest 90,000 rupees. If it is 20, I'll invest 80,000 rupees. If it is 30, I'll invest 70,000 rupees. If it is at 40, I'll be investing only 60,000 rupees. If it is at 50, I'll be investing only 50,000 rupees. Did you get my point? See, there will be certain cases in front of your screen where the RS at the stochastic value will be something like 75, 80,70. So in that case, you cannot short sell the stock. The stock is still going to go up, but the risk is 75, the reward is 25. So you are taking a 300% risk, boss. At 10%, when the average is equal to 10%, then the risk is how much? 1:9. That is only 11% risk. So when it is about 11% risk, you need to put in the whole 90,000 rupees or lakh rupees. But when the risk is so high, please reduce your quantity, because there is a compulsiveness between people that they want to trade every day, and they will every day call me and ask me for a recommendation. Like last week around, we booked a lot of profits, and when we book a lot of profits, more calls come to me. So today I chose a stock. You will laugh on me that I gave a stock known as HUL to my clients today. Now HUL is one stock which will never move up, never move down by a wide margin. But there is a reason for giving HUL also. We'll come to that later on. But most of the stocks have actually gone up. So, are you now clear with the risk analysis theory, sir? Great. So please, from tomorrow onwards, whenever you are buying or selling a stock, please remember this. The third one which we will discuss today is exit policy. Please exit a stock in big profit for a buy side trade. Please remember this, okay, for a buy side trade. No, it's not an experimentation strategy. This is a strategy you need to use in the market. This is a strategy you have to use in the market, because I told you my philosophy is big profit, and small loss. Boss, you can't expect me to give you profits all the time. I'll very clearly tell you this to you in the very first day itself, that you should not expect me to give you a lot of profits, because there will be small losses, big profits, and small profits. Why are these my limitations? Because tomorrow when I'll give you a small loss, people don't want to exit, and that is why I educate people that was take the small loss. And why have I been forced to give you a small loss is something you need to know, because at the end of the day your money will be going down the market. So then you will get angry by getting a loss of 5,000 rupees from me, and then before means like it's better that I give you an explanation beforehand itself why such things do happen with us also. So you'll get millions of people around you who will tell you that you will make profits every day, but I would rather believe in mathematics rather than people and what they commit. Okay. So we had this risk analysis. Risk analysis can only help you get profits. The third is exit profit. Now there can be three ways of exiting. The first way is big profit. I will tell you when there will be big profit. If you buy a stock where the average of G comma R is less than 20, and you sell it when the average of G comma R becomes greater than 70, 75, you'll make a lot of money. Please write this down. Yeah, if the average of G comma R is less than 20, and tomorrow the average value of G comma R becomes more than 70, 75, then you will make a lot of profits, provided G is always greater than R. G should not ever be less than R. Okay, is that clear, sir? Okay. uh, Basically, what I mean to say is that buy a lot of stocks in the oversold region. See, in the stock market you might have heard this oversold and overbought region, but you haven't actually applied it. Whether at 6100 we were overbought or not, you never knew that on the screen. You can know that on the screen only by looking at certain technical parameters. Actually, that is what I want to explain you. You get my point, sir? Hello, you get my point, sir? Okay, great. Second thing, G comma R. Okay, so you will, however, after buying any stock, if on an EOD basis, suddenly one fine morning, due to whatsoever, the value of G suddenly becomes less than R, please take a stop loss and exit. Please remember, however, that if suddenly the value of G becomes less than R, there can be a situation where you are booking a very small profit, or there can be a situation where you will be making a small loss also. However, if you have followed my first two principles of directional analysis and risk analysis, your absolute loss will be very less. However, if you fail to follow this policy, you will be into knee deep trouble with this theory. If suddenly the value of G becomes less than R, as was the case in HDIL the day it crashed, till one day before, I'll show you with HDIL, till one day before it was going fine. 62,58 is okay, the stock is in the current up move. 68,65 is also okay. Look at this, 63.5, 64.65. And boss, if I had given you a buy call, if you had bought it and you didn't sell it at 121 rupees on 21st January 2013 after looking at 63,64, you would have, anyways, many people have lost money. You would have also lost money. There's nothing new about losing money. Everybody around me keeps on losing money. So, I have been kept in such a department where I deal only with people who lose money actually. Anyways, it's my work to educate all such people. Humpty Dumpty again sat on a wall, and it had such a great fall that it hasn't stood up again. So next, what I would tell you is that I've shown you the directional analysis, I've given you the risk analysis, I've given you the exit policy. Please note it down and try to follow that on the stock of HDIL for the last, maybe I guess in front of you we have the chart of the last 9 months. And as you can understand, sir, that I have been speaking since a real long time, I need a 2-minute small tea break for me. Okay, so just allow me 2 minutes. Okay, and once I am done with this tea, I'll get back to you. In the meanwhile, it's your work to go through the screen, and please do not click at the cross button over here. Okay, just click at the Z button over here. Okay, and then I'll show you what to do. Okay, I click at Z, and I can click on any other stock like ICICI Bank. I can click on, if this will directly have the stochastics also. You'll know a lot about the markets over the next 3-4 days, how the markets is going to react. Okay, so this is the ICICI Bank. An excellent sell call is emerging in ICICI Bank. However, there are some other parameters also which I need to see before I give you the sell call finally. But let's see. Okay, then if you double click on Nifty, you'll get the Nifty also. So next 2-3 minutes, or maybe a maximum 5 minutes, please go through any stock you want, and then I'll come up with your doubts first, and after I am done with your doubts, we will go ahead with an examination which you need to pass. And if you pass the examination, sir, I can certify you as a learner. Okay, so can I take a small break, sir? Okay, sir, thank you.